Okay, so welcome to the review of the accounting process. I'm going to prepare various videos for this class. Each one will be 15 minutes long. That's the maximum that that the video permits me to go. And plus, I just think that it's a good time period for you to take a break if you've gone 15 minutes looking at a video, and you could take a break and log into the next one. So I might, continue this video with another one. If it suddenly stops, don't worry. Go on to part 2, which should be in the same location where you found the first one, and so forth and so on. Okay. So through these videos, I'm going to explain the accounting process. Give you an overview of the accounting process. This will cover exam number 1. If you watch all the videos and you understand them, you should pretty much have this should pretty much cover at least 75% of the first test, chapters 1 through 3 in accounting 2021. Okay, so let me get started, and we'll go through the whole process. I'm going to start with an overview of the accounting process. Then I'm going to give you a story that I made up, and if you like, I would suggest that you actually print these tabs before you watch the videos, just so that you could have them right in front of you. And through the story, I'm going to show you the whole accounting process, how we record the transactions, and how we journalize them, and then put them in the ledger, and then do the trial balances, and then build the statements, and so forth. And so by the time we're done with all the videos, you should have a complete knowledge of the whole accounting process. And then from there, all you need to start learning, well, it's not all, it's difficult, but you'll need to start learning the specific rules for each transaction. But the whole process you should learn through these videos, a series of videos that I'm going to do, of which this is part 1. Okay, so the primary financial statements of a corporation are 4. We have the income statement, as you can see here, the retained earnings statement, the balance sheet, and the statement of cash flow. We're going to focus on the income statement and the balance sheet, right? Retained earnings of statement is not really used that much, and it's a very simple statement that reconciles retained earnings from period 1 to period 2. Retained earnings are increased by net income. They're decreased if the company has a loss. They are also decreased by dividends paid. So that's pretty much what this summarizes here for you, and so we're going to skip that statement. I'm not going to show you how the statement of cash flows is done in these videos. Later on in the semester, we will cover that, and so I'm sure I'll post some videos regarding the statement of cash flows. But I'll cover how we come about creating the income statement, which is a summary statement of revenues and expenses for a specific period of time, such as a month or year. In my example, I'm going to do a month. And so the income statement, as opposed to the balance sheet, is a summary of what occurs during a time period. In my example, for example, it's from January 1 to January 31. So it's a whole time period. And it tells you, well, the revenues that you created during that time period and the expenses that you created during that time period. So it covers a specific period of time. The balance sheet, on the other hand, tells you what the company has at a specific point in time. So what assets, what liabilities, and what stockholders' equity they have at a specific point in time. And so you'll get to, for those of you that are new to accounting, I know this is a principal class, so for many of you, you're not so familiar with this, and you'll get to see and understand a little more as the video goes on. And so, obviously you could go back and listen to it again and get a better understanding. Okay, so that's what we're going to do. We're going to learn how the income statement is created and how the balance sheet is created, and talk a little bit about its components and so forth and so on. Okay, so the different type of accounts that are in a balance sheet and an income statement. Let's start off with the balance sheet. Okay, in a balance sheet you have assets, liabilities, and stockholders' equity. So assets are resources owned by the entity. You could look at assets as things that you want, as good things, right? So what do you have in your company? Do you have cash? Well, most companies have cash, right? Do you have furniture? More than likely you'll have furniture. Do you have automobiles in your company? Perhaps you have automobiles in your company. Some assets are tangible, like the ones I just mentioned. Some are intangible. If you have a patent, for example, that's an asset. Something good, right? But it's intangible. It's still an asset. Okay? So we're going to learn a little bit about the various types of assets and how they're classified. That's not going to be the main focus, but the main thing is to understand that assets are resources that the company owns. These are things that you want to have in order to produce revenues. You use them to produce revenues. Liabilities, well, you could say they're things that you don't want to have because they're debts owed to outside creditors. Of course, you got to take that with a grain of salt. There's many companies out there that have debt to outside creditors. I mean, all of them have debt, right? All those companies have accounts payable, and debt could also be a sign of a growing company. So if a company has debt, it's not necessarily a bad thing. It means that the company is growing and that they chose to fund their growth with debt. But all things equal, you'd rather not have debt, right? Just like, just compare it to yourself in your household. Would you rather have debt or not? You'd rather not have debt, right? So debt could be payable in cash, most of it is, or some of it is payable in services, right? So sometimes you have a debt, but the debt isn't that you're going to pay it off in cash. It's that you have a debt to deliver a service or deliver a good to a customer. So that's also a debt. Stockholder equities is sort of the leftover. Assets minus liabilities is stockholders' equity. Here we have the accounting equation. The accounting equation says that assets equals liabilities plus stockholders' equity. Think a little bit about it as a house. Let's say you own a house, and the house is worth $500,000. So that's the asset, right? The house is worth $500,000. But the house has a mortgage, right? So you owe the bank. So how much is that mortgage? Well, let's say the mortgage is $300,000. You owe the bank $300,000. That's the liability. Well, what's left over? $200,000, right? 500 minus 300 is 200. Well, that's your equity in the house. That's what you would walk away if you decided to sell the house today, pay off the mortgage. You walk off with $200,000 clean. And so a company is no different than that. They have their assets, they have their liabilities. If you subtract the liabilities from the assets, you will know what the net equity is of the owners, right? And that's the portion, that's the net value that the owner gets to walk away. So how does that value come about? Well, it could come about two ways. Common stock, right? That's when the owner puts the money in themselves, right? So if you put $100,000 in a company, let's say the company was just beginning. You just put $100,000. Well, you're going to have $100,000 in assets, right? How much equity do you have? $100,000 as well. Zero liabilities, right? Does it satisfy the equation? Assets 100, liabilities 0, stockholders equity 100. So yes. Another form of value that increases stockholders equity is the earnings of the company, right? So when the company earns, and if they keep those earnings and they don't give it to the shareholders, well, it increases the value of the company, and therefore it increases the owner's equity. Okay, so this brings me about to a very important notion, which I've already mentioned, the accounting equation. The accounting equation is expressed as assets equals liabilities plus stockholders equity. And when you see the balance sheet, you're going to see it that the assets are usually on one side, and these two, liabilities and stockholders equity, tend to be on the other side. For me, a more logical way would be to say assets minus liabilities equals stockholders' equity, right? Because, like I said in the example of the house, if the house is worth $500,000 and you owe $300,000, well, 500 minus 300 equals 200. So that's your equity. The leftover is your equity. But so it doesn't really matter. That's a function of algebra. You could express it either way. This is how the books express it, the academics. Assets equals liabilities plus stockholders' equity. Okay? So these are the types of accounts that we will find on the balance sheet. Assets, liabilities, stockholders' equity, common stock, stockholders' equity, which is composed of common stock and retained earnings. And there's some other type of different types of accounts here that are beyond the scope of what we're going to talk about right now, like the paid-in capital and so forth. But let's just bypass that for now. Okay. So for the income statement, we have accounts that relate to revenues, which are officially defined as increases in assets and stockholders' equity as a result of selling services or products to customers. So what does that mean? Well, the simple definition is a revenue is when you sell the product or service to a customer and you get paid for it. You get paid for it usually in the form of cash, right? So that's a revenue. That's a revenue account. There's a difference between revenues and gains. The difference is a revenue pertains to the main operations of a business. So say, for example, my main operations is the maintenance, management of property. Okay? And so the properties pay me money for managing them. Those are my revenues, right? Let's say as a company I have a couple of cars that I want to get rid of. And those cars, I have a book value of $3,000 and I was able to sell them for $5,000. I gained $2,000, right? So that's revenue, right? But it's not a revenue that is from the main operations of the company. The company is a management company, it's not in the business of selling cars. So that $2,000 profit that the company made would be defined as a gain. Okay, expenses are whenever you use those assets, you create an expense, right? In the production of revenue, right? So let's say, for example, let's say I was in the business of buying and selling computers, right? If I buy the computer for $10,000, well, that's a pretty expensive computer. Well, let's say I buy the computer for $1,000 and I sell it for $1,500. Well, my expense is going to be $1,000. My revenue is going to be $1,500, right? And so I used up the asset computer to create my revenue. To create my revenues. Okay, so losses are very similar to gains. Losses are whenever a company incurs a loss that is not from the main operations of its company. So to give you the exact same example, let's say the management company has cars that have a book value of $3,000, but they only sell them for $2,000 in the market, right? So they lost $1,000. But that's not part of their main business. So that would be recorded as a loss rather than as an expense. Okay? So these are the 4 types of accounts that you have on the income statement. Your chapter doesn't even mention gains and losses. I just threw that in for your knowledge. But keep that in mind. Okay? So every company has, as you can see here, a chart of accounts. And the chart of accounts is usually listed in order in which they're shown in the balance sheet and the income statement. As you can see, assets go first, liabilities, stockholders' equity. then revenues,